Welcome to our channel, where we demystify the world of investing. Today we delve into the topic of dividend investing. Imagine having a portion of a company's profits regularly deposited into your account. That's the beauty of dividend investing. It's a strategy where you invest in companies that distribute a portion of their earnings to shareholders, that's you, in the form of dividends. But why does it matter? Well, dividends can provide a steady income stream, independent of market conditions. They can be reinvested to buy more shares, accelerating the growth of your portfolio. And best of all, they can offer a degree of financial security, especially during economic downturns. So whether you're a seasoned investor looking for a reliable income source, or a beginner seeking a relatively low-risk entry into the market, dividend investing might be the right path for you. Join us on this journey as we break down the steps to successful dividend investing. Enjoying this content? Don't miss out on future videos filled with even more tips, tricks, and inspiration. Hit that subscribe button now to stay tuned with us. First things first, what exactly are dividends? Let's dive right in. Dividends are a portion of a company's earnings that are paid out to shareholders. You can think of them as your share of the company's profits. They're a way for companies to distribute a portion of their earnings back to those who invested in them. Now, how do companies distribute these dividends? It's usually on a per-share basis. This means that for every share of a company's stock that you own, you'll receive a certain amount of money. This amount is known as the dividend rate. The timing of these payouts can vary, but they're typically made on a regular basis, such as quarterly, semi-annually, or annually. Some companies might even pay monthly dividends. The specific schedule will depend on the company's dividend policy. Now, let's talk about the types of dividends. The most common type is cash dividends. This is pretty straightforward. It's simply cash paid out to shareholders. The company decides on a certain amount per share, and that's what you receive. But there's another type of dividend, stock dividends. Instead of cash, a company might choose to distribute additional shares of stock. This is a way for a company to reinvest its earnings back into the business, while still rewarding its shareholders. While cash dividends provide immediate income, stock dividends can potentially lead to greater long-term returns as they increase your ownership stake in the company. However, it's important to note that not all companies issue dividends. Some prefer to reinvest all their earnings back into the business for growth. So, to recap, dividends are a portion of a company's earnings paid out to shareholders. They can come in the form of cash or additional shares of stock, and are typically distributed on a per-share basis at regular intervals. Now that we understand what dividends are, we can discuss how you can start investing in them. Diving into the world of dividend investing may seem daunting, but it doesn't have to be. Let's break it down into manageable steps, so you can start your journey towards financial growth and stability with confidence. Firstly, research is key. Begin by identifying well-established companies that have a history of paying dividends consistently. Look for those with a stable financial standing and a reputation for good corporate governance. This will give you a pool of potential investments to consider. Next, you'll want to understand the concept of dividend yield. This is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's calculated by dividing the annual dividend payment by the market price per share. A higher dividend yield suggests a more valuable investment, but it's important to balance this with the overall stability of the company and its future growth prospects. Once you've done your homework, it's time to choose a brokerage account. This will be your platform for buying and selling stocks. There are many online brokerages available today, offering a range of features including research tools, low transaction fees, and even robo-advisors. Choose one that fits your needs and comfort level. Finally, it's time to make your first purchase. Start small and gradually build your portfolio over time. This approach, known as dollar cost averaging, can help reduce the impact of market volatility on your investments. Remember, dividend investing is not a get-rich-quick scheme. It's a long-term strategy that requires patience and diligence. It's about building a stream of income that can support you in the future, whether that's for retirement, a child's education, or other financial goals. With these steps, you're well on your way to becoming a dividend investor. Stay tuned as we delve deeper into strategies for successful dividend investing in our next segment. Successful dividend investing isn't just about buying stocks and waiting for dividend payouts. It's about strategic planning, smart decision-making, and being patient. Let's dive right into some strategies you can employ to become a successful dividend investor. Firstly, diversification is key. Putting all your eggs in one basket is never a good idea, especially in the world of investing. Diversification allows you to spread your investments across various sectors, companies, and even regions. This way, if one area of your portfolio underperforms, others can help balance it out. Remember, the goal is to build a robust portfolio that can withstand market volatility. Secondly, reinvesting dividends is a powerful strategy. It's like a snowball effect. The more you reinvest, the bigger your investments grow. When a company pays you dividends instead of taking a cash payout, you can choose to reinvest those dividends to buy more shares. Over time, this can significantly boost your portfolio's value and potential dividend income. Next, understanding payout ratios is critical. The payout ratio is the percentage of a company's earnings paid out as dividends. A high payout ratio may seem attractive, but it could also mean that the company isn't reinvesting enough in its growth. On the other hand, a low payout ratio may indicate that the company is prioritizing growth over dividends. Therefore, finding a balance is important. A good rule of thumb is to aim for companies with a payout ratio of less than 70%. This suggests that the company is striking a fair balance between paying dividends and reinvesting in its growth. Lastly, focusing on long-term growth is vital. Dividend investing isn't a get-rich-quick scheme, it's about the steady accumulation of wealth over time. Look for companies with a history of consistently increasing their dividends. These are often well-established companies with a track record of stability and growth. They may not offer the highest dividend yields, but they provide the potential for long-term, sustainable income. To sum it up, successful dividend investing involves diversifying your portfolio, reinvesting your dividends, understanding payout ratios, and focusing on long-term growth. It's not about chasing the highest dividend yields, but about building a solid income-generating portfolio that can weather market ups and downs. Remember, investing is a journey, not a destination. It requires patience, discipline, and a willingness to learn. So keep these strategies in mind as you embark on your dividend investing journey. With these strategies, you can maximize your returns and minimize your risks in dividend investing. However, dividend investing isn't without pitfalls. It can be a rocky road filled with common mistakes that can derail your financial journey. One prevalent misstep is the allure of chasing yield. High dividend yields can be enticing, but they're often a sign of a company in distress. A more sustainable strategy is to focus on companies with a history of consistent and growing dividends. Next, let's talk about diversification. Putting all your eggs in one basket is risky. If that one company or sector takes a hit, your entire portfolio suffers. Spreading your investments across different industries can help mitigate this risk. Finally, many investors overlook the importance of considering the total return. Dividends are just one part of the puzzle. You also need to account for capital gains. A stock may have a low dividend yield, but if it's growing rapidly, the total return could be substantial. Avoiding these mistakes can help you become a more successful dividend investor. And there you have it, a comprehensive guide to dividend investing. We've journeyed through the basics of understanding dividends, showing you the ropes on how to start your own dividend investing. We've also unveiled some strategies that could help you succeed in this venture. Remember, dividends are a great way to create a steady stream of income and build your wealth over time. But like all investment endeavors, it's not without its pitfalls. We've highlighted some common mistakes you should avoid to protect your investment and ensure a smooth sailing journey in the world of dividend investing. Knowledge is power, and with this guide, you're well equipped to make informed decisions about your financial future. Thanks for watching. If you found this video helpful, please subscribe to our channel, give this video a thumbs up, and share it with others who might benefit. Stay tuned for more insightful videos on investing.